So, Peter, your investing philosophy is often summed up as buy what you know. And there's some truth to that, and it's also often way oversimplified.
Sure.
Can you explain what you did mean by that and what you didn't mean?
Well, it bothers me that people are very dangerous when they invest. This word play the market, that's a dangerous term. But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. If you could add 8 and 8, get fairly close to 16, you can find out this company has lots of debt, no cash, they're in trouble. You shouldn't own it. So a little bit of research. People are careful when they buy a refrigerator, careful when they take a vacation. And they'll put $5,000, $10,000 some stock to hear on the bus or to party. That's dangerous.
So when you say buy what you know, you also thought that the regular investor might be able to get an inside advantage by sticking to an industry he's familiar with or seeing something that she realizes is a great product.
Imagine if you were in a mall the last 50 years. You would have seen Gap when it was hot. You would have seen Limited when it was hot. You would have seen when it was not hot. You would have seen when they were starting, people weren't excited about Gap anymore. And then you do some research, say, well, gee, there's a lot of limited stores, but we're only at 20. They can go to 400. So you see a company. I did really well with Dunkin' Donuts, a local company. I did well with Stop and Shop. But people could see that this is really some people showing up, or I guess the Sunglass Hut, no one's there anymore. So I mean, that's research. That's fundamentals. So but you don't leave the mall, though, and buy that day. You have to do some more work.
That's the important point.
Yeah.
So today, there's so much information everywhere, information overload. Does that make it harder for active investors? The indexers say everyone's got access to the same information at the same time. You can't beat the market. Well,
the way you beat the index is you avoid the stocks to go down. You avoid the steel companies and the oil companies and Sears and Penny and where the companies are deteriorated. I mean, companies are dynamic. Behind every stock, there's a company. These are not lottery tickets. So you're trying to find the companies within the S&P 500 that are doing better. They're going from crappy to semi-crappy to good. That might take a couple of years, or they're going to grow for a long time. And you're trying to avoid the companies that are going south. That's how you beat them. Or you find some companies outside the S&P 500 that are great companies. CarMax was not in the S&P 500. They went up 200-fold. There's a lot of companies that enter, and a lot of their great performances before they go in.